In this video, we're going to discuss the top 3 dividend stocks that investors should consider purchasing in both bull and bear markets. When the economy improves, the majority of businesses are able to generate the capital required to expand their operations, and some even have enough money left over to pay dividends to their shareholders. Nevertheless, economic downturns and recessions can give rise to a very different narrative. Both growth and capital come to a standstill, which makes it difficult for some businesses to maintain their dividend payment schedules. Strong companies prove their dividend staying power by paying out during both good times and bad. Here are 3 dividend stocks that have proven their durability through good and bad times that you should consider adding to your investment portfolio. Number 1. Digital Realty, stock ticker, DLR. Digital Realty is a real estate investment trust, also known as a REIT, that has a portfolio of data centers located all over North America, Europe, South America, Asia, Australia and Africa, and is well positioned to benefit from the growing reliance on technology and acceleration in digital transformation strategies by enterprises. The demand in top-tier data center markets is robust despite a high occupancy level. This is leading to faster absorption of new construction and increasing the demand for data centers, benefiting data center REITs like Digital Realty. Digital Realty announced in early 2022 its 17th consecutive annual dividend increase, highlighting its tenacity. With the 5% increase, it remained one of a small number of REITs that have increased their dividend each year since going public. The balance sheet of the REIT allows for future increases in that payout. Due in part to the company's steady growth, Digital Realty's dividend payout ratio has decreased over time. In early 2022, it was 77% of its adjusted funds from operations, which is a REIT's closest approximation to earnings. It has more cushion thanks to that manageable payout, and it can keep more money to support growth. The company's credit metrics are also steadily improving, and its balance sheet is of investment-grade quality. As a result, its payout is even more solidly supported, and it has plenty of financial room to keep growing its data center portfolio. In 18 metro areas, Digital Realty has 41 expansion projects in progress. Due to high customer demand, half of this capacity has already been pre-sold. Additionally, the business keeps making strategic investments. In 2022, it acquired the majority of Terraco, a South African data center operator. A solid balance sheet gives the business the financial freedom to keep investing in order to take advantage of the high demand for data center capacity. This demand generator will support Digital Realty's dividend growth going forward. For investors looking for dividend income, Digital Realty appears to be a great buy right now, with the dividend yield rising to 4% after a significant decline in its share price during this year's market sell-off. Number 2. Simon Property Group, stock ticker, SPG. Simon Property Group Incorporated is an American real estate investment trust that invests in shopping malls, outlet centers, and community lifestyle centers. It is the largest owner of shopping malls in the United States. Worldwide, it owns interests in 232 properties comprising approximately 241 million square feet of gross leasable area in North America and Asia. This year's inflation is largely a result of rising energy prices, particularly the cost of gasoline. Gas prices are now declining after reaching a peak in the middle of June. This is encouraging for consumers and ought to increase discretionary spending. People visit the mall for discretionary spending, and Simon Property Group, a mall REIT, will benefit most from this trend. Shopping centers, premium outlets, and the mills are among the 198 properties owned by Simon Property in the country. The pandemic caused a merger that the company also owns an 80% stake in Taubman Group, which was formed as a result. Simon Property, like the majority of REITs, has struggled in comparison to the overall market as investors worry about rising inflation and interest rates. Energy prices are returning to normal, which should give consumers some much-needed relief even though rising inflation is difficult for them. Since the beginning of 2022, Simon Property Group's stock price has fallen about 38%, primarily as a result of rising rates and worries about an impending recession. In spite of this, the company increased its forecast for funds from operations, FFO, in 2022 to a range of $11.70 to $11.77 per share. Simon has a 6.9% dividend yield and trades at 8.6 times FFO per share. For dividend investors, the company offers good value at these prices. Number 3. Highwoods Properties, stock ticker, HWI. Highwoods Properties is a fully integrated office REIT that owns, develops, acquires, leases and manages properties primarily in the best business districts, BBDs, of Atlanta, Tennessee, Raleigh, North Carolina, Richmond, Virginia, Nashville, Orlando, and Tampa. The only exception to the Sunbelt rule, the REIT is selling its properties in Pittsburgh, and it has entered the Dallas market for the first time. The plan seems to be bearing fruit. Since its 1994 initial public offering, the company has consistently provided passive income, and thanks to a fortress balance sheet with a net debt to EBITDA ratio below 6, it is now able to finance its aggressive acquisition and development pipeline without issuing any new equity. During the same period, funds from operations increased by 8% year over year, and the company even increased its mid-year guidance for this important metric by more than 3%. Highwoods Properties has a negative 28.76% total return year to date, but it's yielding an attractive 6.58%. Highwoods Properties also has a very manageable payout ratio of 38% and has increased its dividend every year for 5 years in a row. This increases analysts' confidence in this REIT and leads them to rate the stock as a moderate buy. Based on the company's past performance and current positioning for the years to come, investors can also share this confidence. Which of these 3 dividend stocks that have proven durability in both good and bad times would you like to add to your investment portfolio? Let us know in the comments below. And don't forget to like this video and subscribe to our channel for new weekly videos covering investing strategies, the best stocks to buy, and much more. Thank you for watching.